let's check the chart now. What you can see here is actually we have the buy limit and then we have the sell limit. So you can see here for the buy limit, this is where price is at currently, which is actually the current price. So for the pending order, which is actually in the category of the limit order, and this is actually specifically the buy limit. So this is the current price. So what you're actually saying is you don't want to actually take the entry or execute your trade at the current price. You're looking at executing the trade when the market drops down to this price level, and then you execute your buy entry at this particular price level to trade the markets to the upside. So what this is actually showing you is currently this is where price is at, but then you don't want to execute your trade at the current price. So when you look at this chart here, you would see that this is actually the pending order type, which is actually the stop orders. So you know the pending order is actually into limit order, and then we have stop orders. So this is actually the stop order for the pending order category. Now what you can see for buy stop is that this is the current price. Now your intention to buy is actually that you don't want to buy at the current price. You want to buy above the current price. So the next Forex markets order that we have is actually what we call the trailing stop loss. From the word trailing, you would understand that it has to do with motion. It has to do with movements. It is dynamic in nature. The stationary stop loss is not dynamic. It is only movable when the trader decides to actually change the stop loss price level. But for the trailing stop loss, it is movable as price moves in your favor. It's a stop loss order that automatically moves once profit becomes equal to or higher than a level you specify. We're going to be looking at the bullish candlestick. So the bullish candlestick is actually a buy candlestick, an uptrend candlestick. So when we see uptrend, meaning it is moving to the upside. So what you can see here about this bullish candlestick is that this is the open price level of the bullish candlestick. So since a bullish candlestick is actually an up buy move candle, so it is meaning that the market is going to open at the bottom and then move towards the upside. So what you can see now for the bullish candlestick, this is actually the open price level. So what we can see is that when the market opened, the market gave a movement through the downside to actually create the low. We have price trending to the downside. So you must trade these candlestick patterns in confluence to the market trend, in confluence to the buyers in the market. So what we can see is that you can see price push to the upside. So let's consider this as the bullish candle because this created the highest high. Now what you can see is that we have this bearish candle came to the downside and closed below the low of this bullish candle and also below the open price. The same applies to this candle. So you have this bearish candle engulfed this bullish candle, and now you can see price fell to the downside. Now you have price return to retest this level that price broke to the downside, and then what you can see is that we have this bullish candle to the upside. Price now failed to continue the movement to the upside to close above this bullish candle and also this other candle here. And then what you can see is that we have an expansive movement of price to the downside. Don't forget, this is just a basic understanding of identifying market structure. So you can see here, we have this low points here. And you must understand that this is the United States dollar paired with the Swiss franc. And then you would see that this is the low point, and then price created the impulsive leg move. Price created this swing high points that you can see here. So we have this low, and then we have price created the high. Now we have the pullback to the downside. And you can see now price created the impulsive leg move. And then you can see that we have price broke through the swing high points. So we have break of structure. This is telling us that the market is still in the bullish market condition. So we have the push of price to the upside, and then we have the pullback to the downside. Price created a new higher low points. What you can see here, we have a bearish market condition to the downside. You can see we have the high points here, and then price created the low points because price broke this particular swing low. So we have this low points. So now you can see price gave us the bullish move, which is actually the pullback, and then price created the swing high points. Now you can see we have the expansive move to the downside that broke this swing low points. And then we have the corrective leg move, the expansive leg move, and then we have the break of the swing low points. So you can see that the market is moving to the downside, where price is violating previous swing low points. So what you can see, we have this impulsive move to the upside. Price broke through this swing high points. Now you can see price returned to the downside, created this swing low. But then price push without breaking this swing high. We have this swing low here, created this swing high. Price gave us the pullback, created a swing low. But then this swing low did not create a movement to the upside to actually break through this high points. And now we have price return to the downside. Price again did not push further to the downside to break this swing low points, and then we have price returning to the upside. So you can see how the market is just ranging within this support and this resistance. So you can see that this actually symbolizes the major market condition, and then this symbolizes the minor market condition. So basically what I'm trying to say is this signifies a higher time frame market condition, this signifies a lower time frame market condition. So the higher time frame could be daily, the lower time frame 4 hour, the higher time frame could be 4 hour, the lower time frame is 1 hour. So now you can see that in the higher time frame we actually have a bullish market condition, because what you can see is that we have the market giving us a series of higher highs, higher low, higher high, higher lows. We have the impulsive leg move that broke this swing high points, created a new high point, which is now a higher high. Price gave the impulsive leg move, broke through the swing high point. We have a newly created high point. So now what you can see is that within the impulsive leg move, we are having the minor market structure. So now what you're going to see is that this is the 4-hour time frame. You can see that in the 4-hour time frame, this is the structure within the 4-hour time frame. I've shown us this chart example, but in the daily time frame, this is the structure. We have the low, the high, the higher low, the higher high, the higher low, the higher high, the higher low, the higher high, the higher low. So this is the daily structure. We're having a bullish market condition. But what you can see here in the 4-hour time frame, you can see that we have in this impulsive leg move of the daily directional bias, you have in the 4-hour time frame, we are having this bullish market condition. So this is further example to actually explain the institutional order flow. So you can see we have the bullish market condition here. We have structure to the upside because you can see prices breaking swing high points. So we are creating a bullish market structure here. So what we can see is we have this impulsive leg move and we have the corrective leg move to the downside. So what you're going to see is within the pullback leg move, we have this particular sell move as the last sell move before the impulsive leg move to the upside. So now what you're going to see is this becomes our order flow. So you can see that now we have the return of price to this particular order flow and then price pushed to the upside. I told you guys that the market actually moved to fulfill basically 3 things: take out external range liquidity and then take out internal range liquidity or fill up inefficiencies. So we can see the price return into this institutional order flow. Price did not push further to take out the external range liquidity, and then we have a bearish trend to the downside. Where you can see we have internal range liquidities created here. Now we can see the price return to the upside and then took out the internal range liquidities. And then we can see the price filled up this inefficiency, mitigated the inefficiency here. So in conditions whereby you have an impulsive leg move and you can't really determine the particular ideal zone you would want to look out for to see where price is actually going to face rejection, that is where we now make use of the Fibonacci tool. So in the Fibonacci tool, we have actually a premium price and then we have the discount price. The price above the 50% level is actually a premium price, and then the price below the 50% level is actually the discount price. So you can see now we'll actually take from the swing high here to the swing low here. Now what you're going to see is that we have this buy side liquidity. Indirectly you have an order block here. So now what we can see is we have the break of the swing low and then we have inefficiency in this impulsive move to the downside. Now this is the buy move before the impulsive leg move. Now what you can see is the price return into the impulsive leg move, which is actually also the order flow zone. Price return into it and then filled up this price inefficiency. So in the case where you cannot really identify where to actually look out for price rejection, just the way I've earlier said, and that is when you make use of the Fibonacci tool. So you can see we're going to take from the swing high to the swing low. So you can see we have this inefficiency is actually within the equilibrium price level. So you must understand that the movement of the market is actually to take out external range liquidity, return to fill inefficiency, and also to take out internal range liquidity. So you can see here from this bullish market condition, you can see we have price created the high, we have the pullback, and we have price created the low. So you would understand the multiplex nature of price, that price is actually fractal. You see structure in higher time frame, and then you can also see structure in lower time frame. So basically what we can see within this expansive move is actually the minor market structure formed within the expansive leg move. So this minor market structure forms the internal range liquidity. So now we can see that the market gave the impulsive leg move. Within the impulsive leg move, price created the inducement, which is the buy side liquidity. So you can see price created this low. The low pushed back and then took out the buy side liquidity. So this validates this low point. And now you can see price fell to the downside, creating the inducement, the buy side liquidity. Now what we're going to see is that we have the pullback of price to the upside, and then price fell to the downside. So this is actually our major inducement, because what you're going to see is that price fell to the downside. This is the pullback leg move after the break of structure. We didn't have a pullback leg move before the break of structure. We have that after the break of structure. So once price created this low, price pulled back, price dropped, price did not break this swing low. What we can see is that now price created another pullback within this range, this high and this low. So you can now see this is a minor inducement, because what you're going to see is that this is actually the ideal high point that sponsored this movement to the downside that took out this low point. What you're going to see is price created this bullish candle, but this is not a valid pullback because the pullback did not take out this bullish candle low points. Price continued to the upside. So our range is within this bullish candle. The pullback we're expecting is to see any pullback that will take out this bullish candle low points, because it is actually the highest candle. But this is just an inside movement within the bullish candle, so this is not a valid pullback. So that is why you can see this is our entire impulsive move, and then we have the pullback, because you can see this is the highest candle that price created, and then you can see that this candle went to the downside, took out this candle low points, and then we have this impulsive leg move to the upside.